All right, man. I can't wait to talk about today. You sent me a text not too long ago about an article that you had read online.
Yeah.
What was that?
So in the mornings, I typically I'll get the kids out the door, wife, they all go to school, and I'll make a fresh coffee. And there's, I don't know, probably 15 to 20 different online sites that I go and read different articles, just kind of what's going on in the world today of finance. And there was this one headline, and it was like, the greatest dividend stock that you could own right now. It's paying 15%. And I was like, what? And I mean, before I even read it, I fired it off to you and I was like, bro, we're missing out on something. I'm like, we're letting our clients down. There's some that are paying
chasing 6%. They're paying 15. What's going on?
So then I get totally clickbaited and I start reading and I'm like, man, and one of the big resources that we use is Dividend Investor,
Yep.
Free site, but it's really informative. So I'm reading the article and I'm like, man, this company has a 15% yield. What is going on? So throw it into Dividend Investor and it pops up and I'm like, oh.
Which we'll dig into in a minute.
But it was just really eye-opening, I guess.
So before we dig into that and we kind of flush out, the rest of the show, I think it's a good idea to kind of talk about that clickbait that you just talked about. There's so many times, I mean, we kind of clickbaited this show, the best dividend you could ever buy, right? But at the end of the day, there are headlines out there that are created to get you to check something out,
or just get you to feel emotion, right?
Yes.
Fear or excitement,
whatever
or
it is. Yeah. In this particular case, they threw out a rate or they threw out a phrase, and you're like, hey, let me check that out. This is my field. And then you're reading and you're like, oh, this looks good. And they made it sound so amazing.
Oh, they were the sub headline was crushing the S&P. And it's like, man, you're crushing the S&P. This is crazy.
Which they're talking about dividend.
Yes.
And you can spin anything. But when you start digging into more and more details, because there are times when you get it, I get it, a client will reach out and say, hey, have you ever heard of such and such stock?
Yep.
It's paying, whatever rate of return, or whatever yield. And you're like, yeah, let me look at it. And we do a very quick dive and we're like, yeah, no, it's not on our radar for a reason. There are only so many stocks out there that pay a dividend. We typically look at them all and, we know the ones that are in the top echelon. So when somebody's like, hey, check this one out, we're like, never heard of it. And you look at it, you're like, oh, that's why we don't look at it. So let's pull up this stock. Yep. Let's have some fun with this one. So the stock company was what's the name of it? AGNC
Investment Corp. So it's a REIT, so it's a real estate investment trust.
Yeah. Their dividend rate is $1.44. So for every share that you own, you're getting paid $1.44. Their dividend payout ratio is a little high, but not scary high. When I look at that, I'm like, well, that's actually not horrible. However, the 5-year dividend payout average is 400%. A little concerning.
Yeah.
A 5-year average typically will be, in some instances, if you have a low payout yield or ratio at 40%, and your 5 years at 70, or in this case, it's at 96 with the 5 years at 65. This is a major orange flag, red flag, where we're looking at this and we're going, whoa, 400%, they can't sustain that.
Right.
And then you scroll down a little bit. Okay, first of all, the revenue of this company is $14 million. So this is a tiny, tiny bit of a company.
Yes.
Well, wait a minute. That can't be right because their net income is $1.5 billion. So something's off there.
Yeah.
But their cash flow.
That's the more concerning of either of the two
numbers. If the company is a $1.5 billion company and their cash flow is negative $17 million, I'm in major concernville. Okay.
That's right.
This is a big concern. Their total return over the last 3 years is 10%. Yeah. Negative 10% total return, and their return over the last 5 years is a negative 2%.
That's right.
So when the headline reads crushing the S&P, what does that exactly mean? Because the S&P is positive over the last 3 years and definitely positive over the last 5. I don't get it. What are they referring to?
It was all about the yield.
Their yield is higher than the S&P.
Which is a
15.
15.14, which sounds great.
Yes.
Man, I can give you $100 and you can give me a 15% back on that. That would be amazing.
So to get 15% currently now, you would have lost 2% over the last 5 years.
Right.
And yet somebody took the time to write this exhaustive email or the exhaustive article to get you to click on it. And then when you do a little bit of research, you find out that this stock is garbage. Like it's lost 10% over the last 3 years, 2% over the last 5 years. Look at their yield history.
It's crazy.
This is Christmas gone wrong right here.
It's the
complete
horrible opposite of what we look for.
This is stealing right here. So the green is good. So when you see like way
3
back,
years.
I don't know what year that is.
Let's
it paid
probably 08.
08,
09,
paid $1.31
10.
a share, then went up to $4.95 a share, then $5.60 a share. Like we're killing it.
Yeah, maybe got over their skis.
Well, I think what happened is they started this right at the tail end of 08 when real estate was in the dump.
Some really great real estate.
Bought great. And then they're like, after a while, they're like, oh, this isn't as easy as I thought because the deal's dried up. And then they realized that they went way high in their yield. And then they got, like you said, way over their skis, crushed themselves to the point where like, well, we have to start cutting this yield back because we're either leveraged too high. I mean, who knows the finances? I didn't dig in that much. But the reality is they were killing themselves.
400%.
Yeah.
It's telling us.
How do you go from $1.30 to $5?
Yeah.
In 3 years.
And
2 years.
Yeah. And REITs a little bit, if I'm not mistaken, don't they have to pay out a certain portion of their income?
If they're classified as a specific REIT, I don't know how this is classified as, but it's typically 85%.
Yeah.
And this is a dangerous proposition.
That's right.
So you read a headline, you get excited, you're like, oh, I want this 15%. And then the reality is this is literally garbage.
Yeah.
This is a horrible investment.
And that's where just shopping high yields can really get you in trouble, right? So you got to look a little bit deeper than just the yield, which we showed a little bit of that. But
and there's clients that'll email me, give me a call, be on the phone. Hey, check out this. It's paying 10, 12%. I had one call me up, an advisor actually, and say, hey, this stock or this fund is paying over 20%. I'm like, 20%. And then you dig into it and you're like, there's no way. I wouldn't even spend $100 investing in that and hope of a flyer to make 20%. It's garbage.
Yeah.
It's like this. There's a reason why a stock pays a high yield. It's typically because their stock price got crushed.
Right. And the yield works inverse.
Yes.
Which is the opposite
stock price
to the
goes
stock
down,
price.
Yield price goes up.
That's right.
Stock price goes up,
Yep.
yield price goes down.
Because on the flip side of that coin, we've also had clients reach out and they're like, hey, why are we even holding this stock?
It's only paying 1%.
The yield's 1%.
Yeah,
And
we
it's
bought it at 7.
Yes.
And the stock is, grown 400%,
That's right.
and that's why it's now 1.5.
Yes. So
Yes.
your account balance for that particular stock
Is off the charts.
is off the charts,
Yeah.
and your yield because of where you bought it is still pretty good on the money that you put in.
The biggest concern that I feel like we see, if you scroll up here, actually you can just stay right there. The biggest concern is, a client will reach out and say, or we're introducing dividends for the first time, and they'll say to us, well, how guaranteed are dividends? Well, they're not. I mean,
Spoiler.
yeah, there's no guarantee on dividends. Let me show you a chart to prove it. This is it right here, where you see, an increase, which is awesome, and then a horrible decrease, which is terrible. Yet they still continue to pay. But this is the reality of dividend investing gone wrong.
That's right.
Where you see all the good intentions, the terrible management, and it took them a long time to adjust. We could argue it's a good buy, but I wouldn't trust this company. Their management looks horrible to me just on how they're running their finances. We haven't even dug into their finances, but they're not even making money.
Right.
But you'd go, hey, this is a great time to buy. They're down in the gutter. This company might be headed for disaster.
Right. In 2 years, it may not even exist.
Exist. I wouldn't touch this at all because you have to follow the money.
That's right.
And then when you dig into something like this, it scares me. So, but the point that I want to make here is that you have to really pay attention to where the money is coming from and where it's going, their leverage, because dividends are not guaranteed.
That's right.
And if you don't do a good job, you're going to find yourself in a situation like this where you buy your income at 15 or whatever. I don't know what their yield was back up here, But let's just say it was 10%, you know, and they're like, hey, let's go get on this train. They paid $1.30 last year, and now they're paying $5. And then all of a sudden, two things blow up in your face. Your income gets cut by 80%.
Right.
And then the value of your portfolio gets crushed by 50, 60%. Because typically, if a stock cuts its dividend, the price falls off a cliff.
Right.
So another thing is the danger of leverage. And, you know, this is a real estate company. And real estate typically makes its living on leverage.
That's right.
So if you're going to buy a dividend stock that has real estate, it's going to be really important to follow the money. So we've got another stock up here that we have a lot of experience in, realty company. The stock symbol's O, and this is not an endorsement or anything like that.
No.
But the reality is,
just wanted to show apples to apples.
Apples to apples. You have a very high payout ratio here of 300%. Last 5-year history is 260%. There's a lot of reasons that go into why they're paying there. They paid their first dividend in 1994. They have increased their dividend for the last 19 years. If you look here, they have got awesome cash flow.
Yep.
If you look, their revenue is $6.3 billion. Their cash flow is $4.2 billion. And their net income is well over $1 billion. The stock has gotten hit, and because of commercial real estate has been hit a little bit.
Yeah, it's even, 3 years you're looping in kind of the tail end of COVID there with commercial real estate.
Real estate got really hurt
and
in COVID.
Interest rates have been moving back up. So their rates, which that's a whole nother line.
A whole nother, And then scroll down to their dividend. Their dividend's been a rock star. You know, are they
20 straight years?
Yeah, it's you know, when you look at the cash flow, the return of the stock hasn't been the greatest. The yield has been very, very promising. They're making lots of money. Just Wall Street doesn't love them right now.
Right. It's just a tough environment for commercial real estate in general.
And again, we're not endorsing this. We're just helping educate. This is what an apples to apples comparison would look like of a poorly run real estate investment trust versus a very well run investment trust. Both are struggling to make money because the entire industry is getting hurt in the market. But if you look at their cash flow, you're like the good guy versus the bad guy, a good manager versus a bad manager here. And that's all we're really pointing to.
That's it. Yep. So, you know, we want to be sure that you don't chase that yield. Be sure you really
do your research.
Do your research, because you may get that yield for 1 or 2 payments, but it might shift,
blow up in your face.
You might lose the whole amount.
And the best advice I could probably give is just be patient. Just relax, you know, make sure that if you're going to make an investment decision to buy a stock, that you understand what you're getting into. And if it's a flash, if it's a headline, be very, very weary. If it's not sexy, it's probably worth your while. If it's super sexy, you need to run.
Yeah. Warren Buffett always says, never invest in anything that you can't understand.
Yeah.
Because if you can't understand the business and how they make money, you'll never be able to figure out when to buy, when to sell.
So be careful of headlines.
That's right.
Don't make rash decisions. Not that our clients are, but for those who aren't clients of ours, you know, just be very, very careful and leery of the headline articles that you see. Click on them.
Yeah,
you know, this led to an awesome discussion.
That's right.
You know, there's nothing wrong with being the clickbait, you know, and being the one that looks at it, because then you're going to learn a ton. Like when we dug into this, we're like, how horrible is this?
Yep.
It was probably some PR person for the firm that that wrote the article trying to attract business to get their stock out of the gutter.
That's right.
Because it's a terrible investment. Yeah. And no good journalist worth its weight in anything would have been like, hey, go buy your money in this, if they understood how it worked.
Correct. Yeah. The yield got them.
So this has been good.
That's awesome. Thanks.